Happy Wednesday out there, Team 42. It's your skipper here, Darius to present our macro minute for Wednesday, April 30th, 2025. As always, we'll start with the executive summary from today's leadoff morning note. If you would like to review the analysis supporting these conclusions and to see if you need to make any changes in your portfolio to remain on the right side of market risk, you need to be a client of 42 Macro. So today's key macro question is, will President Trump's policy pivot sustain the bull run? Our answers are: evidence continues to mount in support of our thesis that the bond market broke President Trump on April 9th. President Trump's first 100-day speech verbally doubled down on tariffs, even as he continued to backtrack on them by providing more delays and loopholes. He also openly criticized the Fed chair, but he stopped well short of calling into question Fed independence. Although it is not our base case scenario, risk assets can continue to rally indefinitely if the Trump administration and Congress pull forward the timing of entering "quote unquote" paradigm C. The policy interventions required to facilitate an accelerated transition to paradigm C would allow investors to look through the U-shaped economy that remains ahead of us by pricing in a V-shaped market instead of the W-shaped market that we currently still anticipate. Refer to our April 2023 and April 2024 leadoff morning notes for more details regarding paradigm C and the policies that the Trump administration and Congress would likely use to pull forward the timing of that outcome. The following wisdom from our April 10th leadoff morning note is worth reiterating today. 42 Macro clients, remember what we have consistently coached you on all year. Number one, bear markets are at least twice as hard to risk manage as bull markets are easy. Number two, leave the shorting of assets to the highly paid professionals that are being compensated for taking on four-sided portfolio construction risk and the added stress that entails. And number three, the distribution of probable economic outcomes is as wide as most investors have ever seen, so remain dispassionate and ready to pivot if and when Kiss and Dr. Mo pivot. Odds are you'll thank them later, even if you do not understand or trust why in the moment. The market is smarter than we are, and someone always knows something. Transition to our 42 Macro dashboard. As always, I'll wrap up with a question from our community. This one's titled Trump Tariffs, Treasury Buybacks, Dollar Liquidity, Surge, Equity Bitcoin Rally Ahead. Says Darius, longtime sub, first-time writer. Thanks for all your great work. Chances of this happening in your opinion. So thanks for the kind of comment. Appreciate you guys for being a long-time subscriber. Says if Trump policies are trigger bond market volatility, i.e. the move spikes and the Treasury initiates buybacks, then the dollar liquidity would rise and hedge funds would exploit reduced margin pressure to amplify leverage in the basis trade. The mechanism here is the trigger tariffs create bond market stress, raising volatility and margin requirements for hedge funds. The policy is Treasury buybacks to ease liquidity strains by allowing funds to roll positions into cheaper, more liquid bonds and lowering margin needs. And then the outcome is freed up collateral enables funds to increase leverage, indirectly expanding dollar liquidity despite technically supply neutral buybacks. This process remembers the 2022 RRP drain, which preceded Bitcoin's rally and signals similar liquidity driven gains for risk assets. So the thought process here, I like and respect, very detailed and very data driven, detail oriented. The problem here that I see and why I don't think it's a high probability is that one, the Treasury buyback programs are like raindrops in an ocean in terms of their size relative to the size of the marketable Treasury market, which is just shy of $30 trillion. We're talking like they're doing like tens and hundreds of millions of dollars of buybacks in a marketable Treasury market that's like $30 trillion big. So it's not a big enough, it's not going to move the needle at all. What happened in 2022 is that we started to concentrate, Treasury Secretary Yellen started to concentrate debt issuance incrementally on the short end of the Treasury curve for a variety of reasons, most notably to satisfy a robust, historically elevated market demand for short duration instruments. We saw the Fed's reverse repo facility balloon to about $2.5 trillion by Q3 of 2022, so she started to essentially say, well, why would I, cause more problems in the bond market and issue coupons and bonds when I can just issue a bunch of bills because there's $2.5 trillion of free money sitting there waiting for a home. And, it's parked on the Fed's balance sheet because it can't find a home in the bill market. or doesn't want a home in the commercial paper market or other short duration credit instruments. So that was smart policy. Another reason, in my opinion, that was smart policy is that we saw, if you look at the spread between the Treasury's weighted average interest rate across the various segments of the Treasury market, bills, notes, bills, notes, bonds, and tips. The only place in the market where Janet Yellen was getting a discount to issue relative to the Fed's or relative to the Treasury's existing portfolio of debt was the bill market. If they started dumping a bunch of bonds, and again, this is back from 2020, the second half of 2022 and throughout 2023, if they dumped a bunch of bonds on the market, what would happen is they would have to pay a higher cost of capital for the bonds in their portfolio or in their portfolio of leverage because the bond yields were much higher than the bonds yields for the existing debt. Same with coupons, same with notes, same with tips. The only segment of the Treasury market where there was an actual discount in terms of market rates being lower than the rates that were already on the books was the bill market at that time as well. So it was it was just smart policy in my opinion. I think the current Treasury Secretary Scott Bessent, who he was hypercritical of that policy, back when she was doing it in 2023. But since then, he has come out and reaffirmed the policy twice now in the Q1 and Q2 quarterly refunding announcements. So I think I know what we're doing here when we talk about these very esoteric, liquidity dynamics. I think the current U.S. Treasury Secretary made a pivot towards our view that we've held since the second half of 2022. So there's that. But getting back into the question, I don't think that Treasury buybacks are going to create enough dollar liquidity to cause a significant rally in Bitcoin and stocks here. Don't forget, we still have the RRP balance, which is $2.5 trillion back then. It's somewhere around $100 billion-ish right now. You just don't have enough dry powder from that perspective to catalyze this. Now, you could still see a wave of liquidity come from both. You could see a wave of liquidity come from foreign central banks. The Fed is eventually going to get involved if growth slows down fast enough. Again, that's going to be on lag relative probably to other international central banks like the PBOC and other central banks where inflation is much less of an issue. But that's an avenue where we could see liquidity come from a global liquidity perspective. And you also have the credit cycles are in an upturn as well, both domestically and globally. So that's where a lot of liquidity comes from as well. As long as we continue to see credit expansion, the credit impulse, both domestically and globally, be positive, and they are accelerating on a trend basis as well. So that's noteworthy in the context of supporting liquidity. But what's a drag, what is and what will be a drag on liquidity after maybe after April is a very high probability deceleration in global trade flows, and that's going to slow the accumulation of foreign exchange reserves and the dollar recycling that we tend to see. So all told, there's a very mixed picture as it relates to liquidity. I still don't see the same kind of dramatic bull run in liquidity that I think other analysts have been calling for. But I could see a scenario where liquidity is higher over the medium term, and that would be supportive for risk assets like stocks and crypto and Bitcoin. So just want to, I'm not saying that is the modal outcome, but I do believe that those are the kinds of dynamics that would contribute to kind of the underlying, question here becoming true. So hopefully that was helpful. And if not, shoot me an email, shoot me a text, or not, don't shoot me an email. Just reply to the question in the queue. We can keep the conversation going. So Darius Dale here, wrapping up our macro minute for Wednesday, April 30th, 2025. Best of luck out there today. We'll catch you back here tomorrow. Cheers.